You wouldn't question your GPS when it reroutes you around traffic. You trust the data, follow the directions, and arrive on time. But when your trading plan signals a setup and the price action doesn't feel right, doubt creeps in. You hesitate. You wait for one more confirmation, or you skip it entirely. The difference isn't the tool, it's the trust equation you haven't built yet. And without that equation, your plan is just a document you reference when things are easy. The moment of abandonment always happens the same way. Your setup appears. Your rules say enter. But something inside resists. Maybe the last 3 trades didn't work. Maybe this one looks slightly different from your backtest. Maybe you're thinking about the loss you can't afford instead of the process you need to follow. And in that moment, the plan loses. Not because it failed, but because you didn't trust it enough to let it work. Most traders think this is a discipline problem. Just follow the plan. Just execute. But that advice misses the point. You can't discipline your way into trust. Trust is built on 3 components, and if any one of them is missing, doubt will win every time. The first component is clarity. The second is consistency. The third is probability. Together, they form the foundation that lets you act when it matters most. Clarity means your plan is specific enough to execute under pressure. Not trade breakouts, but enter on the first pullback after a breakout above resistance with volume confirmation and a stop 2 ticks below the swing low. The difference is brutal honesty. Vague plans create decision points, and decision points create hesitation. When your brain has to interpret your rules in real time, it will interpret them in favor of comfort. That's not weak. That's human. But it's also why unclear plans don't survive contact with the market. Consistency means you've executed the plan enough times to see the edge play out across a series. 1 setup isn't data. 5 setups isn't data. 50 setups start to show you something real. And until you have that sample size, you're not trading a plan. You're testing it. Testing feels different from trusting. When you're testing, every loss feels like proof it doesn't work. When you're trusting, every loss is just part of the distribution you already accepted. That shift only happens through repetition. Probability means you've detached from individual outcomes and started thinking in series. This is the hardest component because it goes against instinct. Your brain wants to know if this trade will work, but your plan doesn't predict trades. It predicts results over time. The traders who trust their plans have made peace with uncertainty. They know that a good process can lose today and still be right over the week, the month, the quarter. They're not gambling on the trade. They're compounding the edge. Here's the test. If you've got clarity, you can execute your plan under pressure without second-guessing the rules. If you've got consistency, you can lose 3 times in a row and still take the 4th setup. If you've got probability, you can close a red day and feel neutral because you know the outcome that matters isn't today. Most traders are missing at least one of these, and the one they're missing is the one that's costing them the most. So if you're preparing for the week ahead and you know you've been abandoning your plan at critical moments, don't just tell yourself to be more disciplined. Ask which part of the trust equation is broken. Is your plan clear enough that a stranger could execute it? Have you run it long enough to trust the edge? Are you focused on this trade or the next 100? The answers will tell you what to fix. And fixing the right thing is how you stop abandoning your strategy when it matters most. Because in the end, the market doesn't reward confidence. It rewards consistency. And consistency only exists when trust is built on something more solid than hope.